With the Fed likely to raise rates this year, there's some concern about how stocks will fare. Senior economics reporter Steve Leisman joins us with a look at something that could significantly offset the Fed's action. Steve?
Mike, good morning and Happy New Year. Federal Reserve rate hikes, inflation, the impact of the virus all weighing on the outlook for equities this year. But what may not be well appreciated, stocks essentially have a built-in hedge. As inflation rises, so too do corporate revenues, pumping companies full of cash. Wharton professor Jeremy Siegel, he was on Squawk Box on Friday, and I talked to him afterwards. He offered up this chart showing that dividends from S&P companies have outpaced inflation over the long run. As inflation rises, dividends go up, so do share buybacks. He told me the long-term history is that earnings and dividends go up with the price level, both in high and low inflationary times, not year for year, but over the long run. The S&P Total Return Index shows that companies have been able to keep pace with inflation and then some throughout most of this pandemic. And this has happened even though buybacks and dividends, they've not kept pace with the increase in free cash flow. So according to Jonathan Golub of Credit Suisse, in the year ahead, Golub thinks that there's substantial scope for the return of cash to shareholders to increase. But he thinks that that's going to be more true for old line manufacturing companies rather than, interestingly, for technology firms. Now, Barry Knapp of Ironsides, talked to him too. He told me corporate cash levels are quite bloated, and if they can't use the money, they generally do give it back. Higher dividends and buybacks won't offset every risk factor, of course. Valuations overall could take a hit if the Fed is forced to do more than is currently priced in to contain inflation. But the cash flow to corporations has been keeping pace with inflation, Mike, and so too should the return of that cash to investors in 2022.